Good morning, everybody, and thank you for spending the time with us this morning. We've got a quick presentation, catch up with Omri Thomas, manager of the Nedgroup Investments Opportunity Fund. He's going to take you through our views of the world and the ability of the Nedgroup Investments Opportunity Fund to achieve inflation plus 5 going forward. Thanks very much for joining us, Omri.
Thank you, Rob, and thank you for everyone calling in. So as Rob said, I've got a few slides, and I'll hopefully leave it open for questions afterwards. So just looking at Opportunity Fund's returns since inception, you'll see that's the green line, and the light blue line is inflation plus 5. So you would see that since inception, we have been able to achieve this return. But I mean, if you look at the whole universe in the medium equity space, it's been a tough target to achieve. Opportunity Fund was nicely ahead of that target until sign-off happened towards the end of last year, and we've dealt extensively with sign-off, so I'm not going to spend much more time on it now. If there are any questions later on where we are with sign-off at the moment, I'm happy to answer that. Safe to say, we think that if you exclude sign-off, we would have been nicely ahead, but unfortunately that cost us a lot. So just looking at the way we are in the world, the current investment climate, we see global conditions normalizing, monetary conditions normalizing. We're expecting further rate hikes coming from the US, and that's on the back of actually quite strong growth that's being seen in the US and also the world. Looking at global growth, we're probably looking at above 4% for this year. So the rate hikes will be in increments of 25 basis points. So it shouldn't have any. It's not going to be a major shock to the market, and the market is currently anticipating those rate hikes. In the UK, Brexit remains a massive uncertainty, and it looks like the process will be delayed even further. In Europe, just as Europe started picking up its head, Italy emerged, and that is keeping Europe under pressure. So it's not like Greece, where it's one of the smaller economies. Italy is one of the bigger economies, and I think it remains a left field risk for a recovery in Europe. What's not helping the world is Trump's trade wars with whoever he's thinking of during the night, whether it's Russia, China, Europe. So that has got global repercussions, and I think that's elevated geopolitical risk globally. In South Africa, it feels like Ramaphoria is fading to Ramaferia. Fundamentals have become or remain extremely challenging. We've got very high debt levels, growth's under pressure. We've got high unemployment, budget deficits remain, and it's going to take time to sort out our SOEs. So a lot of good steps have been taken in that regard, but it will take time for that to feed through to the economy. Emerging markets in general have been under pressure, and that's also impacted the rand. And we held up quite well, but we've seen more recently that we've also the rand's also been under strain. And part of the reason is that the rand is one of the most liquid emerging market currencies. So I don't think we're in the same camp as the likes of a Turkey, Brazil, and Argentina, but global emerging market investors use the rand as a proxy for emerging markets. So just looking at the asset class valuations, where we see value and how we look at the different asset classes. If you recall this slide about 6 months ago, a lot of the asset classes were in the expensive bucket. And what has moved is the SA bonds, SA property, and the rand. And that's as the rand and bonds and property have all sold off to levels where we starting to see value. So we have started increasing our duration within the fund. We have started increasing our property exposure, and what we think remains expensive despite yields lifting is developed market bonds, developed market cash, we still think the yields are quite low there. And I've put in brackets US equities, because we are in expensive US equities, because we still believe that the US markets relative to other global markets are starting to look quite toppy. Looking at the local market, we think it's in the fair bucket, especially after the pullback that we've seen since the end of December last year. European equities, we also see as fair. What's amazing is if you look at the European index, we're at the same level now than we were 20 years ago. So the European market has actually gone nowhere in 20 years. So it's almost a Japanese experience where you've had no returns from equity markets. We think UK property still looks reasonably attractive, and preference shares, particularly in South Africa, look very attractive, and I'll run you through a few of our picks there a bit later. And we think volatility is still relatively low. And why we say it's cheap, because that's what we use to buy protection with. That determines the price of protection. So you'll see I've got two numbers there, a number in brackets and then one without. So all the normal numbers these are weighting to the different asset classes. And where there's a bracket, that's our effective exposure. So looking at SA equity, we've got 44% of the fund invested in SA equity, but of that, an effective 10% is hedged. It's 21% normally, but the effective hedge at this point in time is 10%. So our effective exposure to SA equity is 34%, to European equity 10%, and to US or global equities actually 8%. So that US equity is actually investment in the ABAX Global Equity Fund, which is a bit wider than the US, not only exposed to US. That fund in particular has done well over the last 5 years. It's achieved a return of MSCI Global plus 5%. So a nice alpha that's been added on that side. Now, the type of the topic is how to achieve inflation plus 5. Now, first, let's define what is a reasonable inflation target to look at. So I've just graphed here the long-term, the 5-year rolling inflation number, and that's the target band, this 3 to 6% that the Monetary Policy Committee is targeting. And you can see for most of the last couple of years, bar the GFC, we've been within that bracket. And we expect going forward to continue to see inflation around about the 5 to 5.5% level. So achieving an inflation plus 5 target going forward, one will have to achieve a gross return of 10 to 10.5%. Now, is that still achievable? So on the next slide, I'll just graph all the different asset classes that we can invest in, and then we graph the long-term return of those asset classes, and then the expected portfolio return from that asset class. And you'll see in some cases we expect the portfolio return to be above the long-term return, and that's where we think either the asset class is cheaper than its long-term mean, or because of the specific securities that we own, we're expecting a higher return from that part of our portfolio. So just running through the main ones, you'll see the first column is our weighting. You can see we've got a very low rating to short-term cash, 0.1% and 0.8% in Nedgroup investment flexible income, with about 3% in floating rate notes. So I expected return from the portfolio is about 1.5% real there. We've got SA bonds, which is now our expected portfolio return is 4% real, whereas the long-term weighting or long-term return has been about 2.5% from bonds. And part of the reason why we see an improved return there is because of the sell-off that we've seen recently. So Opportunity funds duration has increased from about 0.25 to currently 0.43, and we will continue to look at adding to our duration into weakness. Inflation linkers, expected real return of 2.5% from the portfolio. And then one of the more attractive parts of the portfolio, and that's why you'll see we've got a 6% weighting in there. We're looking at the nominal return there of 13.5% on our basket of preference shares, which will give you a real return of 8.5%. Now, the individual securities that we own in there would be things like the PSG preference share, which, if you look at PSG, it's got a very healthy balance sheet, so we think your credit risk there is extremely low, and in the meantime, you're getting a 13.5% pref dividend, which is also a very tax-efficient return. So if you gross up that return to look at the pre-tax return, and you compare it to pre-tax returns that you can get on other interest-yielding assets, that compares extremely favorably. Other preference shares that we include in there, or that we have exposure to there, is the Zambezi Platinum Pref, which pays out the coupon of prime plus 4. It's a cumulative preference rate that you get, so you don't get paid it annually. It's a bullet payment right at the end, but in the meantime, it accrues within the share price. So a very attractive, we think, part of the portfolio. Similar to that, we've got exposure to convertible bonds, and that current expected real return from our convertible bonds basket is 8.5%. And the reason why that's so high is because those convertible bonds are basically busted. And what we mean by busted is the strike price of where it converts into equity is significantly above where the shares are currently trading. So you basically just getting the coupon, but the coupon on the convertible bonds that we own is yielding also about 13.5% on average at this point in time. SA property, after the sell-off, we expect a return going from here to be above the long-term return at about 6% real. In SA equities, the long-term return has been 7%, and we think despite the good run that we've seen in our markets, in the local market, we think it's still very achievable going forward, especially if you look at our SA equity portfolio's position, and I'll maybe just at the end run you through our top positions to show, or to highlight why we think that is achievable. Global equities, as we said, we've seen a very good run in the US. The long-term return has been about 6%. Global growth, very strong, but we believe global the real return from global equities will be lower than the long-term return because of the strength we've seen in global markets. Global bonds, we've seen a sell-off in global bonds, and we think from here on, you're probably looking at only 1% real return, not much re-rating, probably just the current yields being maintained, which is about the 1% real at this point in time. Cash also having picked up slightly. You're probably looking at between 0 and 1% long-term return. But for our portfolio, because of the instruments that we hold in global cash, we think we can achieve a 1% real return. And then global property, which is mostly our exposure is to UK property. Those companies are trading at significant discounts to net asset value. So we think the 5% expected real return from there is probably a conservative estimate. Now, if you look at that weighting within the portfolio, and you multiply that with the long-term return, at the bottom at the grey row, that is what the portfolio should yield in long term. So that's a real return of 5. But we think our portfolio, the way we position, can achieve 5.6. So we still think even in the current environment, a target of inflation plus 5 is achievable. It is a tough ask, and most balance funds haven't been able to achieve it over the last 5 years. But one must take into account that over that time, you've seen significant rand strength. If you look at the typical balance fund, about 25% of your exposure is have been to rand hedges and to foreign assets. Now, if that asset class strengthens, then it places a lot of pressure on the rest of your portfolio to achieve returns. We think from here onwards, you're probably looking at a rand that will depreciate at the inflation differential. So your global part of your portfolio should start giving you or start contributing to returns from here onwards. So just on the next slide, the top 10 positions, and I'm not going to run through everyone, maybe just, as I said, highlighting the first 3. And you can see there's an asterisk next to some of those positions, and that means that we've got hedges over that part of the portfolio. Now, starting with Naspers, as you know, Naspers trading at about 3,200 Rand a share. Just the investment in Tencent is worth 4,600 Rand a share. The other assets of Naspers we value at another 900 Rand a share. So we think Naspers is probably worth 5,500 Rand a share. You can currently buy it at 3,200 Rand a share. Now, that's not that discount to net asset value is not new. It's been there for a while, even though it's widened. So why will that change? Well, we think you have to look at 3 things. One is we think the growth in Tencent will continue. So just to give you an indication, Tencent, as you know, is mostly known for WeChat, which is similar to WhatsApp. They've now got over 1 billion users on WeChat at this point in time. Now, more recently, or not more recently, but the last couple of years, the major growth has actually been on the gaming side and on advertising revenue. Now, on the gaming side, if you look at, they've historically had a very strong market share within the PC games, running at about, it was 5 years ago, it was about 15%. Over the last 5 years, that's grown to 25%. Now, the total gaming industry is growing by about 20 to 25% per annum, but most of that is in the mobile gaming space. Now, 5 years ago, Tencent's share in mobile gaming was only about 3%. That's now running at 23%. So over the last 5 years, their market share has gone from 3 to 23 in a market that's growing at 25% a year. Now, the reason for that is, one is that they've had very good games, but they've also been very aggressive in acquiring any new game that looks like it could be a hit. So in the last 12 months of all the M&A activity that's happened in mobile gaming, Tencent has done 75% of the deals by value, 50% in numbers, but 75% in value. And part of the reason why they're so successful in being able to do these deals is because they've got this massive platform. If you're a new game developer and your game is starting to go to get traction, if you put it on the Tencent platform, you've currently got 1 billion users that could potentially play your game. So it's moved from your valuation on your little game that you've built, moved from $1 million worth $1 million to worth hundreds of millions of dollars just because you've partnered with Tencent. So they've been very successful in attracting new games that's popular. So just to give you one recent example, and maybe you guys, or if not yourself, your kids are playing it. It's a game called Fortnite. It's owned by Epic Games, and Tencent owns 40% of Epic Games. Now, They've launched Fortnite, the newest edition of Fortnite, which is called Battle Royale, 3 months ago. In its first month, it achieved a turnover of $100 million. Second month, $200 million. Third month, $290 million. Now, they haven't even released it in China yet. So you can just imagine the type of growth that one will see there. And Tencent's got the exclusive rights for the mobile version in China. So the point I'm trying to make is we think the runway for growth in Tencent is still massive, and the monetization of the user base is extremely low. So again, as an example, they stream up till the end of last year, they streamed one advertisement per user per day. They doubled that last year to 2. Now, when you compare that to someone like a Facebook, they do 40 a day. So their monetization of the user base from an advertising perspective is still extremely low. And what their strategy has been, don't irritate our users. First, build the user environment and increase the size of the moat, and then slowly and in a measured pace, you introduce further advertising space. Now, I mean, they can double it to 4 or to 8, and it will still be substantially below where other peers are in terms of advertising. In addition, because they've now got this platform, they're starting to keep on loading additional value-added services. So there's a WeBank, which is basically an asset manager, and it's now the biggest asset manager within China in the money market space. So from not being there at all 4 or 5 years ago, they're already the biggest there, and I mean, they can still expand into other products. So I don't want to spend the whole time on Tencent and Naspers, but we think there's substantial upside there. And then at the same time, it's not, the second point I then want to make is it's not reflected in the Naspers share price. So you're getting exposure to this high growth asset, which is worth, as I said, 4,600 rand, 4,700 rand per Naspers share, and you're getting it at 3,200 rand a share. So you're getting it at a substantial discount, plus the growth that you're going to get there. And then the third point is, so what will release that discount? Now, there's a lot of pressure on management to unlock that discount. We probably in the next 5 years will see some kind of a corporate action where the other assets get stripped out of Naspers and get a separate listing. Maybe it looks most likely that there will be a separate listing of the other internet assets in the Netherlands, and then it's very difficult to put a negative value on something once it's listed. So your discount to NAV, to listed NAV, will increase further if the share price remains the same, and we think investors will just see the arbitrage opportunity and use that to buy a few Naspers. So it's a 9.7% position, but of that 9.7%, over 8% of that is hedged. Now, the reason we've done that, and it's one change that we've made to the way we manage the opportunity fund. If you recall, end of last year, we had quite a big position in Steinhoff, and we also had hedges over it. But the way we normally hedge is we hedge for the first 10% of downside. Now, when something falls 98%, a 10% hedge doesn't help a lot. So the one change that we've made after having learned that lesson is for our bigger positions, we'll have deeper hedges. And by deeper hedges, I mean that it's not only for 10%. So in Naspers' example, we've got 3 different hedges, and one of our hedges range from 3,200 rand all the way down to 0. So if there's a catastrophe in Naspers, the Chinese government suddenly expropriates 10 cents from Naspers, and Naspers collapses, for one of the hedges, that protections all the way from 3,200 rand to 0. Similar with Sasol, one of our other bigger positions, we've also got a quite a deep hedge in Sasol. So I've said to you guys we will try and keep it to 15 minutes, and maybe at this point in time I'll just open it up for questions. Thank you.
Irene, if you could open the line for questions, that would be great.
Thank you. If anyone would like to ask a question, please press star and then 1 on your touchtone phone. If you, however, wish to withdraw your question, please press star and then 2 to remove yourself from the question queue. If anyone would like to ask a question, please press star and then 1.
So while we're waiting, just quickly mention Omri has very kindly done a very extensive piece on Naspers for us for our quarterly newsletter. That should be up on the website now, and so take a look at that. And if you have any further questions, there's a lot of detail in there and a really interesting piece to read. So, but whilst we wait, Omri. Last inflation print was pretty low, but the pressure's got to be to the upside for South African inflation. And does that have any effect on where rates might go here in South Africa?
Yeah, Rob, so I think if we look 9-12 months ago, there was more talk of actually further rate cuts. And I think that whole scenario has been removed from the table. So I think the Reserve Bank will be very hesitant to hike rates into an environment where growth is so under pressure. Mm-hmm. They'll try and delay that for as long as they can. As you rightly said, I think more recently the inflation print has been quite low, and they haven't felt that pressure. If, however, the rand continues to blow out and inflation pressures continue to build, I think you could see a rate hike, but they'll try and delay it for as long as they're able to. But if you had to ask me to which side the risks lie, it must be to the upside.
Okay, thank you. Are there any questions on the line?
We have no questions from the line, sir.
Okay. Well, given the timing now, I think it just leaves me to say thank you very much to Omri. Thanks for spending your time with us, and thank you to everyone who's dialed in and is following the slides on the internet. Thank you very much. Have a good day.